All right, today we are pulling back the curtain on global finance. We're going to look at the hidden plumbing that connects all the world's markets, and we're going to see how one single clog in that system can trigger an absolute worldwide panic. Let's dive in.
So, picture this. It's August 5th, 2024. The entire financial world is suddenly staring at Tokyo. In one single, brutal day, Japan's Topix stock index, we're talking a massive, normally stable market, just falls off a cliff. An almost unbelievable 12% drop. For traders, this was a full-blown five-alarm fire.
And here's where it gets really weird. This fire, it didn't just stay in Tokyo. Oh no, it leaped across oceans, and suddenly markets in Europe and the United States were getting torched too. So that's the big mystery we're tackling today. How on earth does a little wiggle in the Japanese yen set off a full-on global stock market meltdown?
Well, the answer lies in this hidden strategy, one that most people have never, ever heard of. But it moves trillions, yes, trillions with a T, of dollars around the globe every single day. It's a trade that operates in the shadows, and believe me, when it goes wrong, it has the power to drag everything else down with it.
So to really get our heads around this hidden force, we need to rewind the clock and go back to that crazy week in August. It's the perfect case study for seeing just how quickly things can go from perfectly fine to absolute chaos.
And I mean, this all happens so incredibly fast. It starts on July 31st. The US Fed says something a little hawkish, which kind of puts everyone on edge. Then, bam, not even a week later, Japan's market is in free fall. The VIX, Wall Street's fear gauge, it just explodes, hitting levels we hadn't seen since the pandemic. The panic goes viral, it's everywhere. And then, poof, just as fast as it started, it's over. The markets snap right back, and everyone is left scratching their heads asking, what in the world just happened?
Well, the answer to that big question has a name. It's called the carry trade. And if you can understand this one concept, you really unlock the secret to some of the deepest, most interconnected risks in our entire financial system.
Okay, so on the surface, the carry trade is actually pretty simple. For ages, Japan has kept its interest rates at basically zero. That makes their currency, the yen, super cheap to borrow. So what do investors do? They borrow tons of this cheap yen, and then they turn around and buy assets somewhere else, like US stocks or Mexican bonds that pay a much higher return. Their profit is simply that difference. That's the carry.
So yeah, it's a simple three-step dance. Borrow low, invest high, and collect the profit. Sounds great, right? But here's the catch, and it is a huge one. This whole thing only works if the Japanese yen stays cheap. If the yen suddenly gets stronger, well, paying back that loan gets way more expensive. And just like that, the entire trade can flip from a winner to an absolute catastrophe.
And this quote just nails the central danger here. See, the carry trade became so popular, it's what we call a crowded trade. It's like everyone is crammed onto the same side of a boat. It's awesome when the sea is calm, right? But the second the weather turns, the second something spooks the market, everyone scrambles for the exit at the exact same time. It's a stampede for a single tiny door.
So right about now, you're probably thinking, okay, that sounds risky, but how big could this possibly be? Well, get ready because this is where the numbers get absolutely mind-bending. The official data, it doesn't even come close to showing the real story.
I mean, just look at the difference between what's on the books and what's hidden. The official on-balance sheet lending shows about $270 billion in yen being borrowed. Okay, a lot of money, but maybe manageable. But the real game is being played off-balance sheet in a market for something called FX swaps. Think of them as short-term currency rentals that don't show up on the main books. And the size of that hidden market? It's a jaw-dropping $14 trillion.
And don't just take my word for it. Hyun-Sung Shin, who's with the Bank for International Settlements, that's basically the central bank for all the other central banks, he points out that this is exactly where the real risk is hiding. These FX swaps are essentially a backdoor way to borrow yen without it looking like a normal loan. It's created this enormous, invisible ocean of leverage that's propping up the entire global carry trade.
But wait, it gets even more complex. Because sitting on top of this $14 trillion mountain of hidden borrowing, there's another layer. A layer that acts like gasoline on a fire during a crisis. And that layer is the options market, and the crucial people at the center of it, the market makers.
So options are these really interesting financial tools. They kind of have two main personalities. On one hand, you can use them for safety. It's like buying insurance for your portfolio. You buy something called a put option to protect yourself if the market crashes. On the other hand, you can use them for pure speculation, making these huge leveraged bets on which way you think the market is going to go.
Now, to juggle all this risk, traders have one number they absolutely obsess over. It's called delta. The best way to think about it is like a risk speedometer. It tells a trader exactly how sensitive their options price is to a $1 move in the actual stock or currency. In the crazy fast world of options, delta is everything.
Okay, so here is the critical piece that connects it all. Right in the middle of this system, you have the market makers. Their entire job is to not take sides, to stay perfectly neutral. So let's say a wave of panic hits and everyone rushes to buy those insurance put options. The market maker is the one who sells them those options. But, and this is the crucial part, to keep their own books balanced, they have to immediately turn around and sell the actual stock. This constant hedging, which normally provides smooth liquidity for the markets, becomes a death spiral in a panic. The more people get scared and buy insurance, the more stock the market makers are forced to sell, which pushes the market down even further, which makes more people scared. You see the loop. It's a massive accelerant.
So let's put all the pieces on the table. We've got a gigantic, super crowded $14 trillion carry trade. We have a complex options market layered on top, with market makers forced to sell when people get scared. So what happens when someone in this crowded theater yells, "Fire"?
It is a complete and catastrophic chain reaction. The first few people who try to get out, their selling creates price pressure. It shoves asset prices down and pushes the yen up. That triggers margin calls at other funds, forcing them to sell too. And they don't just sell the bad trade, they have to sell anything they own it's easy to sell to get cash fast. And all of a sudden, things that have no business being related, like Mexican bonds and US tech stocks, start plunging in perfect lockstep. And just when everyone needs to sell, all the buyers, they just vanish.
And here's the truly insane paradox. The very risk management systems that are built to prevent a disaster, they become the engine of the crash. A big fund will have an automated rule that says if our losses on this one trade hit a certain point, we have to automatically sell a bunch of other stuff to lower our overall risk. So a loss on a yen carry trade can literally trigger a computer to start dumping perfectly good Apple stock. Risk management itself pours gasoline on the fire.
Okay, I know what you might be thinking. This is all fascinating hedge fund stuff, but I'm not trading FX swaps. Why should I care? Well, here's the kicker. This hidden financial plumbing runs directly into your house, right into your portfolio.
This is exactly how the contagion spreads. When some highly leveraged fund gets that dreaded margin call because their carry trade just blew up, they don't have time to sell carefully. They have to sell what they can as fast as they can. And what's often the easiest stuff to sell in a panic? The big popular stocks that you and I might have in our 401ks. And just like that, their problem becomes our problem.
So all of this leaves us with a pretty sobering thought, doesn't it? That mini crisis in August, that was a warning shot. It showed us how a tremor in one obscure corner of the financial world can trigger a global earthquake. And it forces us to ask a really uncomfortable question. As these massive, off-the-books strategies continue to grow, just how much invisible risk is our entire financial system actually resting on?